Hello everyone, in this video today we're going to be going through accounting for contributions and then also dispositions of property, plant, and equipment. So first, what is a non-reciprocal transfer? It is a transfer of assets in one direction. So for example, if a company gifted a piece of equipment to another company for nothing in return, then that would be considered to be a non-reciprocal transfer. Basically, the non-reciprocal transfer is just assets are only going one way, right? In this case, if a piece of equipment is going to one company and then the other company is receiving nothing in return for that piece of equipment, well then that's a non-reciprocal transfer by definition, right? Because the assets are only going in one direction, okay? Companies recognize the transfer at the fair value of the asset involved. The company receiving the asset records a revenue for the fair value of the asset received, while the company gifting the asset records an expense for the fair value of the asset gifted. Additionally, the company gifting the asset records a gain or a loss on the transaction for the difference between the fair value of the asset given up and the book value of the asset. Okay, so we'll see the journal entries of this. This one's actually pretty straightforward. Once you see it in a problem, like it is actually not bad at all. Okay, basically we're just worried about fair values. That's kind of like the main takeaway. We're worried about fair values and we're worried about who's going to record the revenue, who's going to record the expense. Okay, there are two main methods of disposing of PP&E, right? So now we're on disposition of PP&E. First, we have sale of plant assets when a company sells its PP&E for cash or an involuntary conversion when an asset is destroyed by a natural disaster or condemned by the government. Okay. For both of these methods, a company must record depreciation up to the date of the disposal, and then additionally, for both of these methods, a company must compute the gain or loss on the disposal, which is the difference between the amount received for the asset and the book value of the asset. Okay. Those are just a few quick notes. Let's go ahead and jump into some examples. None of these examples are that bad. We just have to remember to do a few things on each one, and then, they're basically set up in a very similar way every single time. Okay, so we should be able to get the points for these, assuming we had questions like this on an exam or a quiz. A non-reciprocal transfer. On November 30th of 2017, ABC Company transferred a piece of equipment to XYZ Company, and ABC received nothing in return. So basically, ABC is transferring a piece of equipment to XYZ, and then they're getting nothing back. Okay. Fair value of the equipment on November 30th, which was, the day it was transferred, was $50,000, which is we care about, right? We're worried about the fair value. We want to know that's $50,000. Additionally, ABC initially paid $100,000 for the equipment and had taken $55,000 of depreciation on the asset as of November 30th of 2017. That's important for recording the transaction on ABC side. Okay. Prepare the journal entry for ABC Company and the journal entry for XYZ Company to record the non-reciprocal transfer. So XYZ Company, again, all they're going to do is that they're going to figure out the fair value, they're going to debit the equipment for the fair value, and then they're going to credit something called contribution revenue. If you can remember from the previous page, it says the company receiving the asset records a revenue for the fair value of the asset received. Okay, so on the receiving side, you just debit equipment or whatever asset you're receiving, and then you credit contribution revenue. Okay. On the side where you're actually giving up the asset, okay, what's going on there? Well, the first thing you're going to do is you're going to record an expense for the fair value of the asset, okay, and then you also have to take the asset off the books and then record a gain or a loss. Okay, so basically, again, when the company gifting the asset records an expense for the fair value of the asset gifted, and then also the company gifting the asset records a gain or a loss on the transaction. Okay, so the gain or the loss, well, it tells us the equipment book value is basically 45, right? Because it tells us it's 100,000 minus 55,000, right? So that would mean that we have to take off the equipment, we have to take off the accumulated depreciation, the gain is 5,000 because the fair value is 50, the book value is 45, and again, that is just cost minus accumulated depreciation. 100,000 minus 55,000 gives us 45,000, gain of 5,000. Okay, that's literally all we have to know for non-reciprocal transfers. Pretty straightforward. Okay, and again, accumulated depreciation must be taken up to the date of the actual giving up of the asset if we're asked to record the transaction on the side of the company giving up the asset, right? So in this problem, it literally gave us the depreciation as of November 30th of 2017. Okay, if it didn't give us that, then we'd have to actually calculate accumulated depreciation up to that point. Okay, but basically those are the main points. The main points are contribution, we're using fair value. The company receiving is recording the equipment at fair value and recording contribution revenue. The company giving up the asset is recording contribution expense at fair value, and then they're getting rid of the asset and recording a gain or loss. Those are basically the main things we want to look at there. And then we have a sale of plant assets. Okay. On April 1st of 2018, XYZ company sold one of its buildings for $750,000 cash. XYZ purchased the building on January 1 of 2000 for $1 million. On January 1 of 2000, they estimated that the building had a useful life of 40 years and zero residual value. And the company used a straight line method to depreciate the asset. XYZ is a calendar year company. Prepare the journal entries to record the sale of the building for XYZ. Okay, so again, the first thing we need to remember for these things, for these journal entries, is that we need to make sure that the asset is updated to its current book value, right? Meaning that it tells us that XYZ is a calendar year company. That means it has a December 31 year end, right? So the last time it would have recorded depreciation was December 31 of 2017, right? So that means that as April 1st of 2018, the asset would not be updated to its current book value as of April 1 of 2018. It would actually be stated at the book value as of 12/31/17, right? Because we just record depreciation when we either sell the asset or at year end. We don't ever really record depreciation at other times, generally speaking. Okay, so the first journal entry we need to make is to actually update the asset to its book value. So then we can determine what's the gain or loss on the sale. Okay, so we want to determine depreciation expense per year. It tells us it's $1 million to start. There was no residual value, and they did just straight line. Okay, so we would just do cost minus residual value over the number of years of the useful life, which is 40, gives us $25,000 per year. Okay, then we know we need to record 3 months of depreciation to update it, right? Because we have to do one for January, February, and March because we're at April 1st. So then we will take the $25,000 per year, multiply it by 3 months out of 12 months in the year. That gives us $6,250 of depreciation we must record on April 1st. So the first journal entry is just depreciation expense, $6,250, accumulated depreciation, $6,250. Okay, that will be our first journal entry, and this is just to update the book value of the asset as of, so that way it's updated to April 1st of 2018. Okay, the next thing we want to do is we want to determine the gain or the loss on the sale of the building, because we know how much it initially cost us and we know the cash, but we need to determine the gain or the loss. Okay, and to determine the gain or the loss, we have to determine what it was sold for, which we know it's $750, and we also have to know the book value or the carrying value of the asset. Okay, so what's the carrying value? Well, it's going to be cost minus accumulated depreciation. We know the cost is $1 million. Well, what's the accumulated depreciation? Well, we've done 18 in 1/4 years, okay? From January of 2000 to April 1st of 2018, that would be 18.25 years of depreciation taken, right? Because we would have taken 18 years up till December 31 of 2017, and then we took another 3 months, which is 0.25 of a year for April of 2018 through April of 2018. So then we multiply that by $25,000 of depreciation expense per year. That gives us $465,250 of accumulated depreciation. Okay, so if we subtract that away from $1 million, okay, we would end up with a value of, let's see, we'll end up with a value of $543,750, okay? And the calculation is done over here. I'm just writing it out. So then we'll take the actual sale price minus $543,750, and we get $206,250 for our gain on the sale. Okay, so we know it's a gain because we're getting more than the book value, right? Okay, so then we just have to journalize this. Okay, we know we received cash of $750. That's easy. We debit cash. We take off accumulated depreciation of $456,250 because we just did that calculation there. So we know it's that number there. Building comes off at $1 million. We know that's what we paid for it. Then the gain is just a credit, okay, to gain on sale of building. Again, make sure you're writing out gain on sale of building, something like that, gain on disposal of building, something like that, because if you just write gain there, you're very likely to lose points on the exam or a quiz. Okay, so that's basically what we want to do. Just to recap, we want to update the asset to its current book value with a depreciation entry. Then we want to determine the asset's book value, determine gain or loss, and then we have everything to make our journal entry. Okay? Finally, we have an involuntary conversion example. So on March 1st of 2017, XYZ company's main manufacturing building was destroyed by a hurricane. The company was able to sell the pieces of the building that were still standing after the hurricane for $10,000. XYZ purchased the building for $500,000 on January 1st of 2017. On January 1st of 2010. On January 1st of 2010, XYZ estimated that the life of the building would be 20 years and that the building would have zero salvage value. XYZ depreciated the building using the straight line method. Okay. So basically, we're required to prepare the journal entry to record the involuntary conversion of the building for XYZ. All right. So again, as we kind of did in the previous example, the first thing we need to do is we need to make sure that the depreciation is 100% up to date. Okay. So in this example, we're going to need to update depreciation for 2 months, right? Because we're at March 1st. Okay. This problem doesn't explicitly tell us that we're a calendar year company here, but if it doesn't say anything, we just assume that it is. That's our normal assumption within this class, okay? It did specify in the other problem that we were a calendar year company. This one doesn't give us those facts, but again, we can just assume that because not given any other information, that is a complete 100% normal assumption to make within the scope of this class, okay? So what we need to do is we need to determine depreciation expense per year. We know it was $500,000 as the initial cost. 0 salvage value, it told us. The building would have 0 salvage value. We're doing straight line for 20 years. That would be $25,000 a year, okay? Then we have to record 2 out of 12 months of the year to update the depreciation. That'll be $4,167. Again, the journal entry is just debit, depreciation expense, credit, cumulative depreciation for $4,167. Okay? So that's the first part. That should be relatively straightforward. We just did something literally the exact same as this, just a little bit different because the numbers were a little bit different, but the overall concept is literally the same thing. Okay, this should be relatively straightforward of just updating depreciation expense. Then we have accumulated depreciation. Okay, we have to solve for because again, we have to get the book value. So we would have recorded 7.17 years of depreciation up till March 1st of 2017 times $25,000 per year gives us $179,167 of accumulated depreciation. Okay, then what we want to do is we want to determine the book value. The book value would be right here, 500,000 minus 176,167 is 320,833. Okay, which means that we only get $10,000 for something worth 320,000. We have a loss of 310. Okay, then we just make our journal entry. We receive cash of 10. Our accumulated depreciation we take off at 179. The building goes out at 500, and we record the loss at 310. Okay, and again, loss on disposal of building, something to that effect is what you would want to write here. You wouldn't want to just write loss straight up. Okay, so basically that's what we do for these problems. We first update the depreciation expense, make sure it's updated to the date of the sale. Okay, and then what we do is that we record the journal entry at the bottom by first determining the accumulated depreciation, okay, solving for the gain or the loss, and then we have everything to make the journal entry. Okay, so that is the end of this topic, and I hope that that was helpful.